Welcome to the deep dive. Today, we're really zeroing in on something important for retirees, something that maybe flies under the radar a bit. State taxes on Social Security benefits.
Yeah, it's a big deal. I mean, think about it. A recent poll said for, 60% of retirees, Social Security is their main income source.
Exactly, a primary source. And for another, maybe 28%, it's at least a minor source. So super important.
And what's, particularly interesting or maybe confusing is you've got the federal government already taxing some benefits based on your overall income picture.
Right.
But then, depending on where you actually live, there can be another layer of taxes.
Yes, exactly. Yeah. Because right now there are 9 specific states where retirees could see a portion of their Social Security income taxed at the state level too. So our goal today in this deep dive is really to, identify these 9 states, break down their specific rules.
Yeah, kind of unpack it.
And just help you figure out if this affects your retirement plans and, what you might need to think about.
And it's worth pointing out, this isn't static, right? Things change.
Oh, definitely.
We just saw Missouri, Nebraska, and Kansas.
Huh?
They all got rid of their state taxes on Social Security just this year, 2024.
That's a great point. It shows these policies really can shift over time, something to keep an eye on.
Absolutely.
Okay, so let's start with the basics. The federal government's role. Many people know the IRS can tax some Social Security based on combined income. Can you remind us what goes into that calculation?
Sure. So combined income, it's basically half of your Social Security benefits for the year.
Okay.
Plus your adjusted gross income, your AGI.
Which is your gross income minus certain deductions, like traditional IRA contributions.
Exactly, those kinds of things. Yeah. And then you also add in any tax-exempt interest, maybe from municipal bonds.
Yeah.
You add those 3 things together. And if that total goes over certain income thresholds, then boom, part of your Social Security becomes taxable at the federal level.
And those federal income thresholds, it's fair to say they're pretty old, aren't they? Weren't they set back in the 80s and 90s?
Yeah, that's a really key point. They haven't been adjusted for inflation basically ever.
Wow.
So because of that, more and more retirees are finding that some of their Social Security is federally taxable, even if they don't really consider themselves high-income earners.
Okay, so that's the federal layer. Now, on top of that, we have these 9 states adding their own rules. Let's start going through them. How about Colorado? What's the deal there?
Okay, Colorado. They actually have a pretty decent exemption. If you're 65 or older, your Social Security is generally exempt from state tax.
Oh, okay. 65 or older.
Or even if you're younger, if your AGI is below $75,000 for single filers or $95,000 for joint filers, you're also exempt.
So that covers quite a few people, it sounds like. What if you don't meet those criteria? Maybe you're under 65 but earn more.
Right. So if you're under 65 and your AGI is above those limits, Colorado lets you deduct up to $20,000 of the Social Security income that was already taxed on your federal return.
Ah, a deduction.
Yes. But anything above that $20,000 deduction amount is then subject to Colorado's state income tax.
And what's their rate?
It's a flat rate, currently 4.4%.
Okay, 4.4%. Got it. Let's move east to Connecticut. How do they handle it?
Connecticut also uses an income-based exemption. It's a bit different thresholds, though. Your Social Security is exempt if your AGI is under $75,000 for single filers.
Okay.
Or under $100,000 if you're married filing jointly.
75 and 100,000. And what if your income is higher than that in Connecticut?
Well, for those with higher AGIs, Connecticut says no more than 25% of your Social Security benefits can be taxed by the state.
Ah, okay. So there's a cap on the taxable portion.
Exactly. And the actual tax rate you pay depends on your overall income bracket in Connecticut, which ranges from 4.5% up to 6.99%.
Okay. Next state on the list is Minnesota. I hear their system is a little more, maybe, complex.
You could say that. It's definitely more nuanced. So Minnesota also starts with an exemption based on AGI. It's below $84,490 for single filers.
$84,490.
And $108,320 for joint filers.
Okay.
But here's the twist. For every $4,000 of AGI, you have above those thresholds.
Right.
An additional 10% of the Social Security benefits that were taxed federally become subject to Minnesota state tax.
Whoa, okay. So it's like a phase-in. The more you earn over the limit, the bigger the chunk of your benefits gets taxed by the state.
Exactly. It's a gradual phase-in, not just a sharp cutoff.
And Minnesota's tax rates, are they on the higher end?
They are, yeah. Minnesota's rates range from 6.8% up to 9.85%. So that phase-in, combined with potentially high rates, means your state tax liability on Social Security can climb pretty quickly once you're over that initial threshold.
Definitely something to be aware of there. Okay, let's move on to Montana. Is their approach simpler?
Yeah, Montana's is more straightforward. Basically, if any of your Social Security is taxed at the federal level, it's also subject to Montana state income tax.
Okay, so it mirrors the federal treatment.
Pretty much.
Right.
But they do have a little something extra for older residents. If you're over 65, you get an additional deduction on your state taxes. It's $5,660.
Where's that? Okay, an extra deduction for seniors and their rates.
Montana's income tax rates range from 4.7% to 5.9%.
Got it. Okay, how about New Mexico? What's their policy?
New Mexico has relatively high income thresholds for their exemption. Your Social Security is state tax-free if your AGI is below $100,000 for single filers.
100,000, okay.
And $150,000 for joint filers.
That seems quite generous compared to some others.
It is. But if your AGI is above those limits in New Mexico,
Then what?
then similar to Montana, whatever portion of your Social Security was taxed federally is also subject to New Mexico state income tax.
And their rates.
Their rates range from 4.9% to 5.9%.
Okay. Let's hop over to Rhode Island. What's the situation there?
Rhode Island, again, uses AGI thresholds for an exemption. It's $104,200 for single filers.
$104,200.
And $130,250 for joint filers. If you're below those, no state tax on Social Security.
And above those thresholds in Rhode Island. Same deal as New Mexico.
Pretty much, yes. If your AGI is higher, then any federally taxed Social Security is also taxed by Rhode Island. Their rates are between 4.75% and 5.99%.
Okay. Seems like a common pattern for some of these states once you're over the exemption limit. Utah is next. How do they fit in?
Utah follows that same initial pattern. If it's taxed federally, it's subject to state tax.
Right.
But they offer tax credit to help offset it.
Ah, a credit. Okay, tell me about that. Who gets it?
The full credit is available if your AGI is below $45,000 for single filers or $75,000 for joint filers.
45 and 75,000.
Right. This credit is specifically designed to basically cancel out the state tax you'd owe on your federally taxed Social Security. And, importantly, even if your income is above those thresholds, you might still qualify for a partial credit.
Okay, so maybe some relief even for those with slightly higher incomes. And Utah's tax rate?
Utah has a flat income tax rate of 4.55%. And that credit, it's non-refundable.
Meaning it can reduce your tax, but you don't get money back if the credit is bigger than your tax bill.
Exactly. It can take your tax down to zero, but no refund from the credit itself.
Got it. Okay, nearly there. Let's look at Vermont. Their rules seem a bit layered, too.
They are, yeah. Vermont has an exemption, but the AGI thresholds are lower. $50,000 for single filers and $65,000 for joint filers.
50 and 65,000.
But then they also have a partial deduction for people whose incomes are just slightly above that, specifically within $10,000 of those thresholds.
So like between 50K and 60K for singles, there's some partial benefit.
Exactly. It phases out over that $10,000 range.
Okay. And what about people with AGIs clearly above that range, say over $60,000 single or $75,000 joint in Vermont?
For those folks, any Social Security benefits that were taxed federally are also taxed by Vermont.
And their rate?
Vermont has quite a wide range of tax rates, actually, from 3.35% way up to 8.75%.
Wow, big range. Okay, last one, West Virginia. This one's interesting because things are changing there, right?
That's right. It's in transition. Currently, they exempt Social Security if your AGI is below $50,000 single or $100,000 joint.
50 and 100,000.
For those with higher AGIs, in 2025, so next year, they'll pay state tax on 35% of their federally taxed Social Security amount.
35% of the federally taxed part.
Okay.
But the big news is for 2026.
Right. Exactly. Starting in 2026, West Virginia is completely eliminating the state income tax on Social Security benefits for everyone, regardless of income.
So they're joining Missouri, Nebraska, and Kansas soon.
That's the plan. Their current tax rates, for context, are 4.44% to 4.82%, but that won't apply to Social Security come 2026.
Okay. This state-by-state look really highlights how different things can be. For people listening, maybe living in one of these 9 states or thinking about retiring there, what are the bigger picture things to consider beyond just these tax rules?
That is such a critical question. Because honestly, deciding where to retire based only on whether Social Security is taxed, that's probably not the best approach.
Right. There's more to life than just that one tax.
Absolutely. Think about the overall cost of living. Things like, housing costs, home prices, rent, property taxes. Those can often have a way bigger impact on your budget than state Social Security tax.
Yeah, that makes total sense. You might save a few $100 on Social Security tax, but pay thousands more in property tax, for example.
Precisely. Or Just general living expenses might be much higher.
What about non-financial factors?
Oh, hugely important. Community aspects.
Right.
What's the access like to good health care? Are there senior services available? What about social activities, things to do?
Proximity to family.
Yes, proximity to family and friends, your support network. These things really contribute to your quality of life in retirement. Sometimes, having a strong community might be worth paying slightly more in taxes.
It's about the whole picture then, a holistic view. But okay, let's say someone is focused on minimizing their overall tax bill in retirement, which is understandable. Are there specific financial strategies they should think about, maybe even before retiring?
Oh, absolutely. Several things. One big one is focusing on Roth accounts during your working years. Roth IRAs, Roth 401ks.
Because those withdrawals in retirement are tax-free?
Exactly. Funded with after-tax money, so qualified withdrawals in retirement, both contributions and earnings are federally tax-free. And crucially, those Roth withdrawals usually don't count towards the income thresholds that states use to tax Social Security.
Ah, that's a really valuable point. So it helps on multiple fronts. What if most of your savings are in traditional pre-tax accounts, like a regular 401k or IRA?
Then you might consider doing Roth conversions before you start taking Social Security.
Explain that a bit.
Well, you'd move money from your traditional IRA or 401k into a Roth IRA. You have to pay income tax on the amount you convert in the year you do it.
Okay, there's an upfront tax hit.
Yes, but then all future qualified withdrawals from that Roth account will be tax-free. So it can potentially lower your overall taxes in retirement, and again, might help keep your income below those state Social Security tax thresholds later on.
So maybe doing smaller conversions over several years before retirement.
That's often a good strategy, yeah. Especially if you anticipate having other income sources in retirement, like pensions. They could push you into higher brackets or trigger state taxes on Social Security. Managing the conversion tax hit over time can be smart.
Makes sense. Any strategies related to regular taxable investment accounts, brokerage accounts and such?
Sure. Just being mindful of managing capital gains can help. Maybe looking at the timing of selling appreciated assets. Also things like increasing the cost basis of investments where possible, or tax loss harvesting during your working years to offset gains. It's about managing that overall taxable income picture.
This really underscores how personal all this is, doesn't it? It depends so much on your individual situation.
Right.
So if someone listening is in one of these states or thinking about moving to one, what's the number one thing you'd recommend they do?
Honestly, talk to a qualified tax professional.
Yeah.
Someone who understands both federal and state tax law, especially for the state you're interested in. They can look at your specific numbers, your savings, your expected income streams, pensions, everything, and give you personalized advice.
They can run projections and help figure out the best strategies for you.
Exactly. It's really an investment, understanding your potential tax liability and how to manage it. It's worth spending a bit of time and maybe money to get that professional guidance.
So, like with so many financial things, planning ahead, getting good advice, that's key.
It really is. The earlier you start thinking about retirement taxes, generally the more options you have. Don't wait until you're about to file that first retirement tax return.
Okay, so let's wrap up this deep dive. The main point seems to be, yes, these 9 states currently tax Social Security for some retirees, mainly those above certain income levels. But the rules really do vary quite a bit.
They really do. From the income thresholds to how much is taxed to credits and deductions, it's not uniform at all.
And as we saw with Missouri, Nebraska, Kansas, and soon West Virginia, these policies can absolutely change.
Definitely not set in stone. It's a moving target sometimes.
So for you, our listener, the real key takeaway is understand your situation. If you live in one of these 9 states or you're considering moving to one, really dig into how these rules might apply to your projected retirement income.
Yeah, and seriously consider talking to a tax advisor. Get advice tailored specifically to you.
Right, because ultimately, while understanding taxes is important, it's just one piece of the retirement puzzle, isn't it?
It really is. A fulfilling retirement is about that bigger picture. Financial well-being, yes, but also your lifestyle, your health, your community, your happiness.
So maybe the final thought is, figure out what kind of retirement life you truly envision, and then see how all these pieces, including taxes, fit together to help you get there.
Yeah.
It's about building that whole life, not just optimizing one single number.
Well said. That's the goal, right? Planning for that complete picture.